You know what's wild? Right now, as you're watching this, you're probably sitting in a car that's actively destroying your life. And I don't mean it's unsafe. I don't mean it's a lemon. I mean it's mathematically dismantling any chance you have at financial freedom, and you have no idea it's happening. Actually, that's not true. You probably do have an idea. There's probably this little voice in the back of your head that knows something's wrong, that knows the $673 leaving your account every month isn't normal, even though everyone around you says it is, that knows you shouldn't still be making payments on something you bought 4 years ago, that knows the dealership guy who said, "We can get you into this for just $599 a month," was somehow screwing you over, even though you couldn't quite figure out how. But here's the thing. You pushed that voice down. You told yourself everyone has a car payment. You told yourself you needed this car. You told yourself that if you can afford the monthly payment, then obviously you can afford the car. And that right there, that's the exact moment you fell into the trap. Because while you've been making that payment every month, that payment that feels so normal now, so manageable, so invisible, you've been quietly handing over your future. Not next month's future, not next year's future, your entire future. I'm talking about actual retirement money. I'm talking about the difference between working until you're 70 and retiring at 55. I'm talking about generational wealth versus generational debt. And the craziest part? You probably financed a Honda or a Toyota, something practical, something responsible. You didn't even buy a stupid car. You thought you were being smart. That's how good the trap is. So let me show you exactly how this works, because once you see it, once you actually see the real numbers, you can't unsee it. And that $673 payment that felt normal 5 minutes ago, it's going to make you physically sick. My name is Rayon, and I spend way too much time thinking about how everyday financial decisions compound into either wealth or lifelong financial struggle. And if you're someone who feels like you're doing everything right, you have a decent job, you pay your bills on time, you're not blowing money on stupid stuff, but you still feel broke at the end of every month and can't figure out why you're not getting ahead, make sure to hit that subscribe button if this video helps you out, because we're about to completely reframe how you think about car payments. So let's start here. When did we all just accept that having a car payment is normal? I'm serious. Think about this. According to Experian's State of the Automotive Finance Market Report from Q4 2024, the average monthly new car payment in America is now $734. $734 every single month for 6 years on average. Used cars? Those average $525 per month for 5 years. And here's what blows my mind. Nobody even blinks at this anymore. We've completely normalized the idea that you should be spending $500, $600, $700 a month on a depreciating asset that loses value the second you drive it off the lot. When did this become okay? Because I'll tell you what, our grandparents would look at us like we've lost our minds. The idea of being in debt for a car for 6 years would have been absolutely insane to them. But we've been so conditioned by dealership financing and affordable monthly payments that we don't even question it anymore. And that's the first trap, the normalization of it. Now, here's where psychology gets really interesting. And this is important, so stay with me. When you walk into a car dealership, what's the first question they ask you? It's not how much car can you afford, it's what monthly payment are you comfortable with. You see what they did there? They shifted the entire conversation away from the total cost and onto the monthly payment, because they know something about human psychology. We think in monthly chunks. Our brains are wired for it because that's how we get paid, that's how our rent is due, that's how everything works. So when a salesperson says, "We can get you into this $45,000 SUV for just $650 a month," your brain doesn't process that as $46,800 over 6 years. It processes it as, "Can I fit $650 into my monthly budget?" And look, if you're making $4,000 or $5,000 a month, $650 might feel doable. Tight, but doable. So you say yes. But here's the math that nobody shows you at the dealership. Let's say you're 28 years old. You take out that $45,000 loan at 7.5% interest for 72 months. Your monthly payment is $693. Over the life of that loan, you'll pay $49,896. That's almost $5,000 in interest alone. Now, you might be thinking, okay, that sucks, but it's not that bad. It's just $5,000. But here's where it gets really interesting, because you're not going to keep that car for 30 years, are you? Of course not. The average person keeps their car for about 6 years, which is conveniently right around when they pay it off. And then what do? They go get another one. So now you're on the car payment treadmill. You pay off your car, you've been making payments for so long it feels weird not to have a car payment, so you trade it in and get another one. Another $45,000, another 72 months, another $693. Let's do the math over 30 years, from age 28 to age 58. If you replace your car every 6 years, which is actually conservative, that's 5 cars. 5 times $49,896. That's $249,480. $250,000 on cars. Most people don't realize this. They're so focused on whether they can afford this month's payment that they never step back and look at the 30-year cost of being on the car payment treadmill. But you know what? It gets worse, because we haven't even talked about opportunity cost yet. This is the part that actually keeps me up at night, because this is where the real wealth destruction happens. Let's go back to our example. You're 28, making $693 car payments for the next 30 years. That's $249,480 total spent on cars. But what if, and just hear me out here, what if instead of financing cars, you bought reasonable used cars with cash and invested that $693 every single month? Let's run the numbers. $693 per month invested in a boring index fund earning an average of 10% annually, which is roughly what the S&P 500 has returned over the long term for 30 years. You know what you'd have? $1.407425. $1.4 million. I want you to really sit with that for a second. The difference between financing cars for 30 years and investing that same money is not $249,480. It's not even $500,000. It's over $1.1 million in opportunity cost. That's the real trap. It's not just the money you spend on the cars. It's the compounding wealth you never built because that money was tied up in depreciating assets instead of appreciating investments. Now, I know what you're thinking. You're probably sitting there going, okay, Rehan, that's great in theory, but I can't just not have a car. I need one for work. I need to get around. What am I supposed to do? Ride a bike everywhere? And look, I get it. I'm not saying I don't have a car. I'm saying don't finance a car you can't afford. Because here's the thing. We've confused needing a car with needing a $45,000 car with heated seats and a premium sound system. Those are not the same thing. You know what's a perfectly reliable car? A 2018 Honda Civic with 60,000 miles that you can buy for $18,000 cash, or a 2017 Toyota Corolla for $16,000. These cars will last you another 100,000 miles easily. They're boring, sure, they don't have all the fancy features, but they get you from point A to point B, and they don't chain you to 6 years of payments. But we don't want to hear that, do we? Because we've been sold this idea that our car is an extension of our identity, that it says something about who we are, that showing up to work in a 2024 model somehow makes us more successful than showing up in a 2018 model. And the car companies know this. The dealerships know this. That's why they spend billions on advertising showing attractive, successful people driving their cars through beautiful scenery with perfect lighting. They're not selling you transportation, they're selling you an identity. And you're buying it, literally. Here's another thing most people don't think about: the cost of waiting to build wealth. Let's say you're 28 right now, and you keep making car payments until you're 45. That's 17 years of $693 going out the door every month. Then at 45, you finally wise up. You pay off your last car, you decide no more car payments, and you start investing that $693 per month. So from 45 to 65, that's 20 years, you invest $693 per month at 10% average returns. You know what you end up with? $478,362. Now that's not nothing, that's a solid retirement account. But compare that to if you had started investing that same amount at age 28 instead of 45. From 28 to 65, that's 37 years. Investing $693 per month at 10% average returns gives you $2,851,420. The difference between starting at 28 versus 45 is $2,373,058. $2.3 million in lost wealth because you waited, because you prioritized having a nice car in your 20s and 30s over building wealth. And this is what I mean when I say car payments destroy your future. I'm not being dramatic. The math is right there. Every year you spend making car payments instead of investing is costing you exponentially more than just that year's payments because of compounding. Now, here's where it gets even more insidious, and this is something I see all the time. People get a raise, right? They're making $55,000 a year, they work hard, they get promoted, now they're making $75,000. That's a $20,000 raise. That's huge. They should be able to start saving, start investing, and start building wealth. But you know what happens instead? They upgrade their car. They're like, well, I make more money now, I can afford a nicer car, so they go from a $350 payment to a $600 payment. And here's the thing, they're not wrong that they can afford it. The payment fits in their budget. But what they don't realize is that they just gave their raise away. They traded a one-time salary increase for a 6-year commitment to higher expenses. According to a 2023 study by the Federal Reserve, 40% of Americans who received a raise in the past year increased their fixed expenses, primarily through upgrading their car or moving to a more expensive home, within 6 months. That's the income trap. Your income goes up, but your wealth doesn't, because your expenses rise just as fast. And the car is usually the culprit. It's the easiest thing to upgrade. It's the most visible. It's the thing that other people see and that makes you feel successful. But you're not more successful, you're just more in debt. Let me tell you about some of the specific psychological tricks dealerships use, because once you see them, you can't unsee them. First, there's the 4-square method. This is where the salesperson draws a square on a piece of paper and divides it into 4 sections: vehicle price, trade-in value, down payment, and monthly payment. And then they just shuffle numbers around between those 4 squares to make it look like you're getting a good deal. They'll show you a monthly payment that seems reasonable, but buried in there is a terrible interest rate, or they lowballed your trade-in or inflated the vehicle price. But your brain sees $599 a month and thinks, okay, I can do that. Second trick, the extended loan term. Used to be car loans were 36 months, then 48, then 60, now 72 and even 84-month loans are common. You know why? Because it lets them sell you more cars while keeping the monthly payment the same. Oh, you can only afford $400? No problem. We'll just extend the loan to 84 months instead of 60. Same payment, nicer car. But what they don't tell you is that you'll be underwater on that loan for years, which means you'll owe more than the car is worth, which means if you want to trade it in before it's paid off, you'll have to roll negative equity into your next loan, and now you're even deeper in the hole. Third trick, the payment-focused negotiation. They never ever talk about the total price of the car. It's always, what payment are you comfortable with? Because once they have that number, they can make the math work by adjusting the loan term, the interest rate, the trade-in value, whatever. I watched a dealership sell a car with a $38,000 sticker price for $52,000 in total payments, $14,000 in interest and fees, and the customer walked away happy because the monthly payment was only $722. This is what we're up against. Okay, so what's the alternative? What should you actually do? Here's the framework I want you to follow, and it's going to sound boring, but I promise you it works. Step 1. If you currently have a car payment, keep the car until it's paid off. Don't trade it in, don't upgrade, just pay it off. Step 2. Once it's paid off, keep driving it. I know, you've been making payments for so long you want a reward, but this is where the magic happens. Keep driving that paid-off car for as long as it's reasonably reliable, 3, 4, 5 more years if possible. Step 3, while you're driving that paid-off car, take the amount you were paying each month and put it in a high-yield savings account or money market fund every single month. Let's say it was $500. That's $6,000 a year. In 3 years, you've got $18,000. In 5 years, you've got $30,000. Step 4. When your current car finally dies or becomes unreliable, use that saved-up cash to buy your next car outright, a $20,000 used car with cash. No loan, no interest, no monthly payment. Step 5, here's where your life changes. You now have a reliable car with no payment. So take that same $500 you were saving for the car and split it. Put $250 in a next car fund and invest the other $250 in an index fund every single month. That $250 going into your next car fund means in 5 years, you'll have $15,000 for your next car. That $250 going into investments at 10% average returns means in 5 years, you'll have $19,465. In 10 years, $51,835. In 20 years, $189,334. You see what just happened? You broke the cycle. You're no longer on the car payment treadmill. You're now on the wealth building escalator. But here's the thing. Math is the easy part. The hard part is the identity shift. You have to stop seeing your car as a status symbol and start seeing it as a tool. That's it. It's a tool that gets you where you need to go. And I'm not saying you can never have a nice car. I'm saying you shouldn't borrow money for a nice car until you've built enough wealth that it doesn't matter. You know what's actually impressive? Being 35 years old with $200,000 invested and driving a modest car. That person is going to retire as a millionaire. You know what's not impressive? Being 35 years old with $12,000 in savings and driving a $50,000 BMW that you're making payments on. That person is going to work until they're 70. But we've got it backwards. We admire the person in the BMW because we can see the BMW. We can't see their bank account. We can't see their investment statements. We can't see their stress about money. So we optimize for the thing people can see, the car, instead of the thing that actually matters, the wealth. It's completely backwards. Look, I want to zoom out for a second because this isn't really about cars. Cars are just the most visible example of a much bigger problem. The problem is that we've been conditioned to think about money in terms of monthly payments instead of total cost, in terms of what we can afford right now instead of what it costs us long term. And this doesn't just apply to cars. It's houses, it's furniture, it's phones, it's everything. We finance everything, we payment plan everything, and we never actually own anything. We're just perpetually paying for stuff. And the companies love it. They've figured out that if they can get you on a monthly payment, they've got you. You'll keep paying month after month, year after year, because the payment becomes invisible. It's just part of your budget. But every dollar you commit to a monthly payment is a dollar you can't invest. It's a dollar you can't use to build wealth. It's a dollar that over time compounds into lost opportunity. And look, I get that sometimes financing makes sense. A mortgage on a house that's appreciating in value? Fine. Student loans for a degree that increases your earning potential? Okay, I'm not a purist about this. But a car? A car is losing value every single day you own it. Financing a depreciating asset is financial self-sabotage, full stop. Now, I know some of you are sitting there with objections, so let me address them. Objection 1. But Rihan, I don't have $20,000 cash sitting around to buy a car. I need to finance it. Okay, first of all, if you don't have $20,000 saved, you probably shouldn't be buying a $20,000 car. Buy an $8,000 car. I promise you there are reliable cars in that price range. Honda Civics, Toyota Corollas, Mazda 3s, they're out there. But those cars are boring and old. Yeah, and they're also paid for, which is going to feel a lot better than being $30,000 in debt for something that's losing value. Objection 2. What if I don't have $8,000 either? Then you do whatever you have to do to save it. You get a second job for 6 months, you sell stuff you don't need, you cut every unnecessary expense. Because I promise you, 6 months of intense saving is better than 6 years of car payments. Objection 3. But new cars are more reliable and have better warranties. Are they though? Consumer Reports data from 2024 shows that well-maintained used cars from reliable brands have nearly identical reliability ratings to new cars. And as for warranties, you know what's better than a warranty? Not having a $700 monthly payment. Objection 4. What about interest rates on savings? I can't earn 10% in a savings account. You're right, for the short-term car fund, you're looking at 4 to 5% in a high-yield savings account. But for the investment portion, the portion you're putting into index funds for long-term wealth building, 10% is a reasonable average historical return for the S&P 500. The point is, even at lower returns, you're still miles ahead of being in debt. We've redefined what afford means. If you ask most people, can you afford this car? They'll say yes if they can make the monthly payment. But that's not what afford means. Being able to afford something means you can buy it without going into debt and without derailing your other financial goals. If taking on this car payment means you can't contribute to your 401k, you can't afford the car. If taking on this car payment means you won't be able to build an emergency fund, you can't afford the car. If taking on this car payment means you'll be living paycheck to paycheck, you can't afford the car. But we've been taught to ignore all of that and just ask, does the payment fit in my monthly budget? And that's how you end up with people making $60,000 a year driving $40,000 cars. The math doesn't match, but the payment fits, so they tell themselves they can afford it. It's insane. All right, so what are you actually going to do with this information? Because look, if you watch this whole video, nod along, think, yeah, that makes sense, and then do nothing, this was all a waste of time. So here's your action plan. If you currently have a car payment, make a plan to pay it off as quickly as possible. Even an extra $100 a month makes a huge difference. Once it's paid off, commit to driving it for at least 3 more years while saving the payment amount. Do not, under any circumstances, trade it in for another financed car. If you're considering buying a car, ask yourself, can I save up and pay cash? If not now, how long would it take? Research reliable used cars in the $8,000 to $15,000 range. They exist, I promise. If you absolutely must finance, put down at least 20%, keep the loan term to 48 months max, and make sure the payment is less than 10% of your gross income. For everyone, calculate your true car costs over the next 30 years under your current plan. Calculate what you could have if you invested that money instead. Let that number sink in. Make a different choice. Look, I'm going to be real with you. Making the decision to drive a modest car while your coworkers are pulling up in brand new SUVs is hard. It goes against everything our culture tells us about success. But you know what's harder? Being 55 years old and realizing you can't retire. Being 60 years old and still making car payments. Being 65 years old and wondering where all your money went. That's hard. Driving a practical car for a few years while you build real wealth? That's not hard. That's just different. And here's the thing. Nobody's going to do this for you. Your car dealership isn't going to talk you out of a sale. Your bank isn't going to refuse to give you a loan. Your friends aren't going to encourage you to drive a beater while they're all upgrading. You have to make this decision for yourself. You have to decide that your future financial freedom is more important than looking successful right now. Because I promise you, 10 years from now, 20 years from now, 30 years from now, you are not going to regret driving a modest car, but you might really regret the $250,000 in car payments and the $1 million+ in lost investment returns. The car payment trap is real. It's destroying the financial futures of millions of people who don't even realize they're in it. Don't be one of them. If this video helped you see car payments differently, hit that subscribe button so you don't miss the next one, and leave a comment below. I want to know, what car are you driving, and are you making payments on it? Let's talk about it. I'm Rihan, thanks for watching. Now go build some actual wealth.